Hey, welcome back to the program. Show's called Your Money or Wealth. Joe Anderson here, Big Al Clopine over there. Thanks for tuning in each and every Saturday, hanging out. Hopefully you're enjoying your weekend, talking investing, some investor mistakes that you're making. And unfortunately, a lot of you make a lot of mistakes when you start looking at your portfolio. I'm not saying never to look at it, but the more you look at it, it's like the more you handle your investments, it's like a bar of soap, right? The more, you handle a lot of a bar of soap, the more you don't have. So, see, that's a really bad joke. And I'm just going to transition to me teaching classes all across Southern California. I see you looking at me, Al. Come learn your financial planning moves. I teach all over Southern California a retirement planning course. If you want to learn how to do this on your own, all you have to do is go to yourmoneyyourwealth.com and check out where I'll be teaching next. Right now it's the fall. It's about 3 or 4 nights a week. I'm at a local community college or a state school in Southern California. Go to Your Money or Wealth. It is free of charge. It's a 6-hour course. You'll learn everything that you need to know on how to put together a true financial plan. When it comes to creating retirement income in retirement, Social Security strategies, do you take the pension or the lump sum, some tax planning ideas, Roth IRAs, Roth conversions, how much should you contribute to your 401k? There's a lot of different tax law that just came out. I explain everything soup to nuts so you have a real defined plan to make sure that you can do all the things that you want to do. Let's go to the true-false question. Let's see how you did here.
When I'm approaching retirement, I should tilt my Roth IRA and non-retirement accounts toward asset classes with higher expected returns to take advantage of lower tax rates. And the answer to that is absolutely true. And this is missed by a lot of people. A lot of you guys put your stocks, your higher expected returns, in your IRA, in your 401k. And you know what? When you pull money out of those accounts, you pay what? Ordinary income tax, the highest of tax rates. If you put those same asset classes in the Roth IRA, you don't pay any tax because it's tax-free. Or in your non-retirement account, it's subject to capital gains, 15% tax, long-term capital gains, if you hold that asset for a year or more. So absolutely, put your more aggressive asset classes in your Roth and your non-retirement accounts.
So when you look at taking stocks, why you want to hold those also in an outside of your retirement account is because stocks are volatile. They go up and they go down. And so there's a tax planning move that you can take advantage of, but also you want to make sure that you do this correctly. Because if you take a look at what most people do, when the stock market is high, you get that greed factor, and then that's when they want to buy. But when the market starts to slide a little bit, then that's where, the fear factor comes in. That's when I want to get out. And then you continue to repeat that behavior until you're broke, because we're twice as fearful to lose money than we are to gain. And if you just put yourself in this position, let's say you had $1 million, and that $1 million grows to $2 million. Okay, think about that for a second. Or that $1 million goes to $50,000. Which is going to affect your life more, right? If I have $1 million, it goes to $2 million. Yeah, that's great, but it's not truly going to affect my life if that $1 million went to $50,000. So you absolutely have to be wary of the downside risk of your overall portfolio. And when things get bad, you cannot sell out and go into cash. And that's what, a lot of times what most people do. And then that's why we see failure when it comes to people's overall retirement plan.
Right, that's absolutely right, Joe. So let's get in. Let's build on top of what Mike Fennison was talking about last segment. How should you properly allocate your portfolio? And what we would recommend is that you probably want to have 12 to 16 different asset classes. What's an asset class? Stocks are asset class, bonds, real estate, natural resources. Stocks could be large companies, small companies, international, growth, value, emerging markets. There's many different kinds of bonds. You want to have a little bit of real estate in your portfolio and a little bit of natural resources. That's your starting point. Then you want to figure out how to fill those various asset classes. And we would recommend that you go with low-cost index funds or ETF funds, because the retail mutual funds out there are very expensive, and research tells us that over time they do not beat the index. So it's important to stay low cost, but don't just buy and ignore. Rebalance your portfolio as appropriate. That simply means if you have one asset class that starts to make a run, sell a little bit of that to get back to your proper allocation, forcing you to sell higher. Buy the asset class that hasn't done as well. Your emotions would tell you to do just the opposite, but that's the way that you successfully invest. And then you also want to tax manage your investments, which, Joe, as you just mentioned, tax loss harvesting for assets outside your retirement accounts is gigantic.
Yeah, I mean, it can add significant value long term. And so what tax loss harvesting really is when you look at a tax managed account is that, all right, if I hold stocks outside of my retirement account and that stock goes down, or the stock mutual fund or the index fund ETF, whatever that you're using to fund your overall retirement, if that goes down, you want to sell it, but you want to buy something similar. You don't want to sell and go into cash. That's what most people do. That's why you fail. But if I buy something similar, then I can utilize that capital loss against any future capital gain in any capital asset. So now that will create a mechanism for me to create tax-free income when I start pulling the money out for a retirement income strategy. Because if you can pay less in tax, then you can take less risk in the overall portfolio. What the biggest mistake, I think, to sum this whole show up, is that most people do not have a specific strategy or a plan in place to make sure that they're funding their retirement, funding their kids' education, passing wealth to the next generation, whatever your goals are. People always hear the hot stock, the hot mutual fund, the hot topic of the day, and they go there. You want to start with a plan to figure out exactly what target rate of return do you need to generate with the money that you have. That is key. Then you're going to have more discipline when markets get a little bit shaky. You can control a few things. You can control fees and costs. You can control risk, and then you can control taxes. If you do those three things, then you can control your stomach when it takes over for your head. If you need any help whatsoever with this, get our free investor toolkit that we're giving away today. Absolutely no cost. Here's the number, 888-994-6257. That's 888-994-6257. That's 888-994-6257. Call that number right now. Everyone that calls today gets the free investor toolkit, absolutely no cost, free of charge. It doesn't get any better than that. Big Al, that's it for us today. Great job, buddy.
It was a fun show, and next week maybe we'll come up with 5 more mistakes because there's more that you guys are making.
Yeah, I'm sure we could come up with 50, but we'll probably change gears. We'll talk maybe tax planning, some different things that came out in the tax law just a couple of weeks ago that we want to get into. I want to thank Mike Fennison, CEO and founder of Pure Financial Advisors, for Big Al Clopine. My name's Joe Anderson. Join us every Saturday, 11 to 11:30, right here on your Channel 4 cable station. Have a wonderful, wonderful weekend, everyone.